the Euro USD was under pressure Thursday ahead of the Jackson Hole Symposium on Friday night, I would say. It is obviously on. It's just that Fed Powell is going to speak overnight after the close of the markets. So we're going to see how that pans out on Monday. However, we've lost the 116 handle, heading towards 1530 next, and then opening the door to 114, following the RSI divergence. We talked about this potential opportunity, if you may, a few days ago. Since then, it has received further catalysts to the downside because we had an unexpectedly hawkish tone at the FOMC minutes that were published on Wednesday, and the odds of a rate cut in September came down to 70% from 80 a day before on Tuesday, and even 90, 95, and even fully priced in at some point a few weeks ago. So traders seem to be pricing in an increased chance that the Fed Chair Jerome Powell will provide a more hawkish outlook when he speaks at that Jackson Hole late on Friday. Now, mind you, of course, that we are reaching oversold territory here, right? And this could still be considered a double bottom. Okay, false break. We're going to see if it holds. But we have a high momentum candle here that heading into the Jackson Hole Symposium, and this is um, a an important and critical junction. Okay, this 116. Hawkish, we head lower. Dovish, we might do a double bottom and start moving higher up. Now, ECB President Christine Lagarde is also going to speak at the symposium. However, we don't know yet what time. With markets expecting the ECB to hold rates at the next meeting, the focus is on the increasing uncertainty around the Fed's rate cut path, because there is some sort of certainty around the ECB's rate cut path. So traders are likely to focus on whether Powell focuses on inflation, which would likely be seen as hawkish, or whether he will address the weaker labor market, which would probably be interpreted as a more dovish sign. Because the truth is that since the NFP last month, the Fed has started looking at its dual mandate a little bit more cautiously, if that makes sense. Um, the first thing I would do is on the medium to short term, let's say, short to medium term, draw our channel down here, because we do currently have to deal with that. Okay, we are in a descending channel. One level of potential support could be the 115.60. Not that it would look like a regular, but an irregular inverse head and shoulders pattern could be at play. But I will just repeat again, it's not looking that pretty. And it would be actually coming probably a bit lower as well. So let's just one level will be there, one level will probably be there. We can find where by simply connecting this to that previous low. Okay, so we would be looking for a potential move down to this level, right? That could be a potential slopey inverse head and shoulders. But the more we deep, the more the chances that this is going to finally break down, further down. The 61.8 lies at 115.20. The 78.6, very critical, is at 114.64. Losing that level opens the door to 114. Then it means that we might go for a new low. So we have to start considering where we are in the longer term. So contextually, The 61.8 is down at 113.57. And then we're looking at our lower territories. We don't need to go that far. There is no signs of a potential bullish divergence, okay, which suggests potential further downside potentially, right? Um, Typically, this is the first leg, obviously coming near to. If Fed is hawkish, we're going to probably see a breakout, okay, and then that could give us the divergence. We'll be looking for a potential pullback to the upside, and this area is going to determine whether we're going to continue lower or we're going to continue higher, because you have other things at play here, like for example, what is going to happen around the ceasefire deal between the Ukraine and Russia, because we talked about this in the previous video, and although in the short term might not be moving euro too much because everybody's focused on the Jackson Hole Symposium, it might have a bigger effect going down the line once the symposium is done, once markets have interpreted the Fed Chair Powell, and once, of course, next week's Nvidia earnings are also out, because that could see a big shift in risk sentiment as well. Now, with that one done, with those two done, okay, we need to look at the previous. Okay, this would be the first, the second, supposedly. Ideally, how we want to connect this would be something like that, right? Initially, okay, because that would be the second wave, that would be the fourth wave, supposedly. So I'm showing you this because it becomes quite important as we head lower. Okay, this um, potential cross between the lower channel and the 11530 sort of support. This is going to be a very important level, guys. So in the short to medium term, let's say, and typically it's not really a good idea to go in ahead of such events, um, unless if you're really good at managing volatility and don't mind the widening spreads. I would be looking for a potential short if the Fed was um, hawkish. So we would be looking, let's say, if we saw a move to the downside, it would probably just be followed with a correction up to 16, right? And then another leg to the downside. So let's see how we could potentially play around that, right? If we do see an initial move to the downside down to 115 because his Powell is going to be hawkish, this is likely to be um, uh, a retest and potential move to the upside to flip this resistance to support. I would be looking, based on how hawkish he is, to place pending orders around the 38 to 61%, right? If he's hawkish, but markets interpret it as a little hawkish, I will be looking at even perhaps the 23.6, okay, a short pullback. If not, we'll be looking for deeper corrections up to 61.8. Okay, now obviously, if he's very hawkish, we might just break through that level anyway. So it might not be ideal for for an actual correction, if that makes sense. But either way, um, how it evolves, it's going to be probably dependent from a technical standpoint on these levels. The 115.30 is very important, and we'll have to really pay attention at this level. So for me, I would be probably looking for something like, if he's very hawkish, for something like an entry to 32, exit at 70, just above 78, 76.8, if we just capitalize on the Fibonacci, and that gives a risk reward ratio of 2.27. If you're feeling a bit less confident about that, you can even drag that higher up if you want, but the ideal scenario would be to wait for a pullback, because typically, if this turns out being a continuation to the downside, we'll be looking for pullbacks, and that would be a less aggressive entry to the event. Obviously, to the upside, we might still look for volatility to come to bring prices back down to that level, regardless, right? So we will be looking for potentially something like an entry at the channel over here, okay, with a stop loss below 115.30 or so, and a initial target up to the previous high. Okay, that still is a quite good trade, but how it's going to pan out, of course, we're going to have to wait and see what happens on Monday. And this is the weight approach is a bit of an enforcing rule, let's just say, currently, because Fed is really going to be talking after markets are closed. So come Monday, we're going to see where markets are going to head, and volatility could be high.